Disclaimer.
This morning, silver crashed 17% in under 6 hours. Yesterday, it hit $121, an all-time record. Gold dropped 7% after touching $5,626. But here's what they're not telling you. This isn't profit-taking. This is the bond market breaking in real time. China holds $682 billion in U.S. debt, the lowest since the 2008 financial crisis. They've been selling for 9 straight months. And on Monday morning, when markets open, the 30-year Treasury yield is sitting at 4.89%. That's a 5-month high. Your mortgage rate, it just divorced the Federal Reserve. The Fed cut rates. Mortgages stayed at 6%. That's not supposed to happen, but it did. Because the bond market, not the Fed, now controls your cost of living, and China just pulled the trigger. Let me walk you through what just happened, because this Friday morning massacre in precious metals is telling us something critical about the system we're all living inside. Thursday night, January 29th, traders went to bed watching history being made. Silver at $121 per ounce, gold above $5,600. These weren't just new highs. They were records that shattered every previous peak. Then sunrise came, and within the first few hours of trading, silver collapsed to $99. Gold plummeted to just over $5,000. We're talking about billions of dollars in market value evaporating before most Americans poured their second cup of coffee. Now here's what you need to understand about this kind of price action. When metals hit all-time records one day and crater the next morning with this kind of violence, you're not watching retail investors cashing out profits. You're watching margin calls. You're watching forced liquidation. Somewhere in the global financial system, somebody got a phone call at 3 a.m. saying they needed to produce cash immediately, or their positions would be automatically sold by the exchanges. This is what extreme system stress looks like when it plays out in real time, and the timing tells you everything. What happened between Thursday night's euphoria and Friday morning's bloodbath? Nothing in the news cycle that would explain a 17% crash in silver. No Fed announcement, no major economic data, no sudden resolution to any crisis. Just the grinding invisible pressure of a system that's running out of buyers. A system where the largest foreign holder of our government debt has been quietly walking away for 9 consecutive months while everyone else was distracted by stock market headlines. Let's talk about those divorce papers between your mortgage rate and the Federal Reserve, because this is where the facade completely falls apart. The 30-year Treasury bond is yielding 4.89% right now, the highest level in 5 months and climbing. Meanwhile, the Fed just paused their rate-cutting cycle in January 2026, after spending months trying to bring rates down. In the old playbook that worked for decades, when the Fed cuts rates at the short end, long-term bond yields are supposed to follow along like an obedient dog on a leash. That's basic monetary policy transmission, the kind of thing they teach in Economics 101, but that leash just snapped. The bond vigilantes have seized control. These are the massive institutional players, the sovereign wealth funds, the foreign central banks who actually show up at Treasury auctions and decide what interest rate they'll demand for lending our government money for 30 years. Right now, they're demanding higher rates despite everything the Fed wants, and they're doing it for one simple reason. They're looking at who's selling our bonds and realizing the buyer base is shrinking fast. You know what this divorce means for your actual life? Every person thinking about buying a house or refinancing their mortgage is about to get slammed with higher borrowing costs that have absolutely nothing to do with Fed policy. The Fed can cut rates to 0 tomorrow. They can do emergency cuts. They can hold press conferences and promise easier money. None of it matters anymore because mortgage rates track the 10-year and 30-year Treasury yields, and those yields are now being set by the bond market itself, not by the Federal Reserve. Your cost to borrow money for a home is being determined by whether China wants to keep funding our deficit spending. And according to the latest Treasury International Capital data from the U.S. Treasury Department, China has made their decision crystal clear. Their holdings of American government bonds dropped to $682.6 billion as of November 2025. This isn't just another data point to scroll past. This is a 16-year red line being crossed, taking us all the way back to September 2008 when Lehman Brothers collapsed and the global financial system was in complete meltdown. Back then, China was buying our bonds to help stabilize everything. Now they're selling, and that reversal is a flashing warning sign that something fundamental has changed. For 9 consecutive months, China has been a net seller of U.S. Treasury bonds. Not a pause, not a slowdown, active selling month after month. At the exact same time, the World Gold Council reports China has been buying physical gold for 13 straight months. They're not selling our bonds and sitting in cash waiting for a better opportunity. They're systematically converting paper dollars into hard assets that sit in vaults, that can't be inflated away by any central bank, that don't depend on political promises or government credibility. They're moving from paper to physical metal, like someone who knows exactly what is coming next and wants to be positioned before the crowd figures it out. Think about the scale of what we're watching unfold. This isn't some hedge fund adjusting their portfolio allocation. This isn't a pension fund rebalancing. This is the second largest economy on planet Earth, a country that holds more of our debt than any foreign nation except Japan, systematically walking away from the Treasury market for 9 straight months. Every time our government holds an auction to borrow more money, that's one less major buyer sitting at the table with their checkbook open. And when a buyer that size leaves the room, somebody else has to fill that gap, or yields climb higher until they find a price that attracts new buyers willing to take the risk. This is the hidden mechanism that most Americans never see behind the curtain. When the evening news talks about government spending and the deficit, it sounds abstract and disconnected from whether you can afford groceries or make your car payment. But it's not abstract at all. Every single dollar the federal government borrows has to be purchased by someone in the bond market. For years, that someone was China, taking the dollars they earned from selling us manufactured goods and recycling them right back into Treasury bonds. It was an elegant system that kept both economies humming along. We bought their products, they bought our debt, and the cycle spun smoothly year after year. That cycle is breaking down right now. The evidence is staring us in the face every time we check mortgage rates or look at Treasury yields moving in directions the Fed does not want. The professionals who trade bonds for a living have a name for what's happening. They call it the bond vigilante moment, when the market itself starts disciplining government fiscal policy by demanding higher and higher yields. We watched this happen in the United Kingdom back in 2022 when Liz Truss tried to ram through massive unfunded tax cuts, and the bond market revolted so violently her government collapsed in weeks. We're seeing the same dynamic taking shape here in the United States, except our bond market is orders of magnitude larger, and the consequences ripple across the entire global financial system. Here's a question worth asking. What actually happens when a bond market doesn't just correct or have a rough week, but truly breaks? Your mortgage rate climbs? Yes, but that's just the opening act. Corporate borrowing costs spike, which means companies slash expansion plans and freeze hiring. State and local governments find it suddenly expensive to fund infrastructure repairs or school construction. Car loans get more expensive, credit card rates jump, student loan costs rise. Everything that runs on credit, which is basically the entire modern economy, gets more expensive all at once. The whole system runs on the bond market functioning smoothly, and when it doesn't, every piece downstream starts to malfunction. We're watching silver drop 17% in 6 hours after hitting all-time records. We're watching gold give back 7% from historic peaks. We're watching Treasury yields climb despite the Fed trying to cut rates. We are watching China liquidate Treasury holdings at a pace we haven't seen since September 2008, when the financial world was on fire. These aren't 4 separate stories that just happen to be occurring at the same time. These are all symptoms of the exact same underlying condition, a bond market that is losing the one ingredient it absolutely needs to function: confidence that there will always be another buyer at a reasonable price. On Monday morning, when markets open after this weekend, we're going to discover what happens next when that confidence keeps cracking. The margin calls that hit Friday morning in the metals markets were just tremors before the real earthquake. China's 9-month Treasury selling streak just put $682 billion worth of pressure on a system that was already showing stress fractures. The 30-year yield, sitting at 4.89%, is telling you the bond market has stopped listening to the Federal Reserve. And your mortgage rate, staying locked at 6% despite Fed cuts, is showing you in the most personal way possible that something fundamental just broke in the machinery that is supposed to keep borrowing costs under control. The question isn't whether this is happening anymore. The Friday metals massacre and the Treasury yield spike already answered that question. The real question is what happens on Monday when institutions come back to their desks, look at the damage, and have to make decisions about what to do next. Do they buy the dip in precious metals, betting this was just profit-taking? Or do they recognize this was forced liquidation ahead of something bigger? Do they keep buying Treasury bonds at 4.89% yields? Or do they join China in heading for the exits while they still can? Those decisions, made by traders and fund managers you'll never meet, are about to determine what your mortgage rate looks like, what your retirement account is worth, and whether the cost of everything in your daily life is about to jump again despite what any politician or central banker promises you. Now, let me show you the evidence that proves this isn't just market volatility. This is mathematical inevitability playing out in real time. The silver market has been running a 30 million ounce annual deficit for years. Every single year, demand consumes 30 million more ounces than mines produce. That gap gets filled from above ground inventories that have been draining for 6 straight years. Demand for 1 kilogram silver bars has exploded 500% since late 2025. These aren't retail collectors. These are institutions and wealth managers buying physical metal in size because they've done the math. Silver lease rates tell you everything about the actual shortage. During recent stress periods, lease rates, the cost to borrow physical silver for delivery, spiked 30 times normal levels. When borrowing metal costs 30 times more than usual, That's a market screaming that physical supply is nearly impossible to find. The exchanges raised margin requirements just like in 1980 and 2011 when silver went parabolic. But here's the critical difference. Back then, warehouses were full. Prices crashed because speculation got out of hand, not because metal ran out. This time, inventory is actually depleted after 6 consecutive years of deficits. Friday's crash was smart money recognizing that when inventory is this tight and prices go parabolic, exchanges will step in with margin hikes before the squeeze becomes a crisis. They took profits from $80 to $121, and they'll buy physical metal back at lower prices, while the shortage continues worsening. This wasn't panic. This was tactical profit-taking by people who know there's a second act coming. Now, let's talk about the Federal Reserve's hostage situation. At the January 2026 FOMC meeting, 2 committee members dissented in favor of cutting rates. One was Governor Christopher Waller, a potential candidate to be the next Fed chair. When a future Fed chair candidate publicly votes to cut rates, that tells you the internal concern at the central bank. But here's what should terrify you. Despite those dissents, long-term Treasury yields moved in the exact opposite direction. The 10-year Treasury is at 4.26%. The 30-year is at 4.89%, both higher than before the Fed meeting. The Fed signaled easier policy, and the bond market just ignored them and pushed yields higher anyway. The Federal Reserve no longer controls long-term interest rates in our country. They can set overnight rates and hold press conferences, but they cannot force the bond market to accept lower yields if buyers won't show up. And buyers aren't showing up because the marginal buyer just left the building. That marginal buyer was China. For years, when Treasury auctions struggled, China would show up with massive dollar reserves and buy enough bonds to stabilize everything. After 9 months of selling and holdings at $682 billion, the lowest since 2008, China is done playing that role. Now, primary dealers, the big banks, required to make markets and government bonds, have to backstop auctions themselves. They're buying not because they want to, but because they're contractually obligated, and they're immediately trying to offload those bonds to anyone who'll take them. This is what a market looks like when it's lost its marginal buyer and is held together by mandatory participants who would rather be anywhere else. Then there's the dollar creating a perfect storm. The US dollar just hit 4-year lows in January 2026, erasing all the gains from the Fed's aggressive rate hiking campaign. We're back where we started, except now with much weaker fiscal position and higher debt levels. And President Trump publicly stated he's not concerned about the dollar's decline. The dollar is falling to 4-year lows, Treasury yields are spiking, and the official White House position is essentially a shrug. Meanwhile, geopolitical tensions are escalating in ways that normally would strengthen the dollar as a safe haven. Iran conducted live-fire military drills in the Strait of Hormuz, where 20% of the world's oil flows daily. The European Union designated the Islamic Revolutionary Guard Corps as a terrorist organization, massively escalating diplomatic tensions. Under normal circumstances, Middle East tension would strengthen the dollar as investors seek safety. But the dollar is falling anyway, which tells you something fundamental is broken. President Trump announced Kevin Warsh as his nominee for next Fed chair. Warsh is a well-known anti-quantitative easing hawk who has spent years criticizing the Fed's money printing programs. He's on record opposing the emergency bond buying that saved the system in 2008 and during COVID. His nomination signals that when the next crisis hits, don't expect the Fed to ride to the rescue with unlimited money printing. Think about this combination. A weaker dollar that normally the Fed would support with higher rates. A hawkish Fed chair nominee who opposes quantitative easing, meaning no safety net when bonds sell off. And China actively selling treasuries, removing the one foreign buyer large enough to stabilize markets. You've got weaker currency, potentially hawkish central bank, and massive bond selling all happening simultaneously. This is the perfect storm that breaks systems. When the dollar falls while treasury yields rise, global investors are losing confidence in dollar-denominated assets across the board. They're looking at our deficit spending, our debt-to-GDP ratio, our political dysfunction, and demanding higher returns to compensate for 30-year risk. This is why China converted paper dollars into physical gold for 13 consecutive months, while selling our bonds for 9. They're moving ahead of the crowd, quietly repositioning while most Americans remain completely unaware. The Federal Reserve is trapped. They want to cut rates to support the economy and prevent recession. But if they cut while the dollar falls and yields rise, they accelerate the loss of confidence, driving foreign buyers away. If they don't cut, they risk pushing us into recession, collapsing tax revenues and worsening the deficit. There's no good option left, only choices between different types of pain. Friday's metals crash revealed how fragile the system is. Even good news, metals hitting records, becomes dangerous because it exposes how tight physical markets have become. Exchanges forced liquidation before the squeeze got out of control. But that didn't fix the underlying shortage. It didn't refill depleted inventories. It just bought time and reset prices for the next leg higher. Monday morning is coming. Institutions return to their desks. Treasury auctions continue. China keeps selling. The dollar keeps falling. The Fed remains stuck between terrible options. And your mortgage rate stays disconnected from Fed policy because the bond market now makes its own decisions about what interest rate compensates for lending to a government that's lost its largest foreign creditor exactly when geopolitical tensions rise and currency confidence falls. Let me show you the math that makes Monday morning so critical. Because numbers don't lie, and these numbers are screaming at us. Markets open February 3rd, 2026. That's this Monday. Right now, as you're watching this on Friday night or over the weekend, the 10-year Treasury is sitting at 4.26%, and the 30-year is at 4.89%. Mortgage rates in America track those long-term Treasury yields, with a typical spread of about 1.5 to 2% to cover the bank's risk and servicing costs. Do that math with me. 4.89% plus 1.75% gets you to 6.64%. That's where 30-year fixed mortgage rates are mathematically headed within weeks, not months. But here's what makes this truly devastating for every American homeowner or anyone thinking about buying a house. When China was still buying our bonds, when they were the marginal buyer stabilizing auctions, that spread between Treasury yields and mortgage rates stayed relatively predictable. Banks knew they could package mortgages into securities and sell them because there was always demand for yield. Now that $682 billion hole in the buyer base means banks have to hold more risk on their own books. They can't offload it as easily, so they're going to demand even wider spreads to compensate. We're looking at mortgage rates hitting 6.5 to 7% within weeks. For every American with a mortgage or thinking about buying, let me put this in terms you'll feel immediately. On a $400,000 mortgage, the difference between 6% and 7% is $300 per month. That's $3,600 per year, every year for 30 years. That's over $100,000 in additional interest you'll pay over the life of the loan, assuming rates don't go even higher from here. And refinancing to escape your current rate, forget it. If you're locked in at 3 or 4% from the COVID era, you'd be insane to refinance into 6.5 or 7%. You're trapped in your current house, even if you need to move for work or family. The entire American housing market is about to freeze because the cost of borrowing just became prohibitive for anyone who doesn't absolutely have to move. This is what happens when the bond market breaks. It doesn't just affect traders on Wall Street, it reaches directly into your monthly budget and squeezes. Now let's talk about what the silver to gold ratio is actually telling us, because this is where you can see smart money making their moves before the crisis fully unfolds. Thursday night, when silver hit 121 and gold was around 5,500, that ratio compressed to 45 to 1, meaning you needed 45 ounces of silver to buy 1 ounce of gold. Historically, that ratio sits around 80 to 1. For centuries, across different monetary systems and economic conditions, silver has traded at roughly 80 ounces to 1 ounce of gold. When that ratio compresses to 45 to 1, one of two things is happening. Either silver is massively overvalued in a speculative frenzy, or gold is catastrophically underpriced relative to the currency collapse fears driving buying. Given everything we've just walked through, China selling bonds, the Fed losing control of yields, the dollar hitting 4-year lows, it's pretty clear gold was underpriced relative to the crisis that's building. But silver went parabolic ahead of gold, which always happens when retail investors pile into the cheaper metal thinking they're getting the same protection. Friday's correction from 121 to 99 in silver wasn't the crisis ending. It was smart money exiting their positions. Before the real crisis hits, not after, they bought silver at $80, $90, maybe $100. They rode it to 121. They saw the ratio hit 45 to 1 and said this is unsustainable in the short term, even though the long-term thesis is intact. They took profits, and now they're waiting to rebuy physical metal at lower prices, while the inventory shortage continues grinding away in the background. You know what that tells you? The correction is your opportunity, not your warning to stay away. When physical inventory is depleted after 6 years of deficits, when demand for 1 kilogram bars is up 500%. When lease rates spike 30 times during stress, Friday's crash was the market giving you one more chance to position before the next leg higher begins. The smart money already took their profits. Now they're watching to see who understands what just happened and who panics and sells at exactly the wrong time. But here's the calculation that should change how you think about your entire investment portfolio, because this goes way beyond just metals or bonds. The classic 60-40 portfolio, 60% stocks, 40% bonds, is officially dead. That allocation strategy worked for decades on one simple principle. When stocks fall, bonds rise, as investors flee to safety and vice versa. The negative correlation between stocks and bonds meant your portfolio had built-in protection no matter what happened. That correlation just broke. Treasury yields are rising, which means bond prices are falling. You're losing money on the bond portion of your 60/40 portfolio. At the same time, the S&P is vulnerable to a credit crunch because when borrowing costs spike, corporate profits get squeezed. Companies that were planning expansions cancel them. Companies carrying variable rate debt see their interest expenses jump. The stock portion of your portfolio is at risk too. When bonds and stocks fall together, that 60/40 allocation offers you exactly zero protection. You're losing on both sides of your portfolio simultaneously. This is what happened in 2022 when inflation spiked and both stocks and bonds crashed together. But this time, it's worse because we don't have the Fed backstop. Kevin Warsh as the next Fed chair nominee means no unlimited quantitative easing rescue when things get ugly. You're on your own. The only thing that survives when the bond market breaks is hard assets. Physical gold, physical silver, real estate you own outright without leverage, commodities that can't be printed or created out of thin air by central banks. This is why China converted over $170 billion from treasuries into physical gold since 2024. They saw this coming. They didn't wait for the consensus view to shift or for mainstream financial advisors to update their models. They quietly repositioned from paper promises into tangible metal while everyone else was still buying the dip in bonds. Silver's Friday crash from 121 to 99 is your final warning shot. It's not the crisis, it's the warning that the crisis is coming and you still have time to position. Monday morning, when markets reopen, cascading margin calls are going to force institutional liquidation of paper assets. When you get margin calls in metals, you don't just sell metals, you sell whatever you can liquidate quickly to meet the cash requirement. Stocks, bonds, anything with a bid. This creates a downward spiral where forced selling triggers more margin calls, triggers more forced selling. The professionals who manage billions of dollars know this pattern. They've lived through 2008. They've studied the mechanics of how liquidity crises unfold. They're not waiting around to see if this time is different. They're reducing leverage, raising cash, and buying hard assets that don't have counterparty risk. Because when the bond market breaks and the marginal buyer is gone, everything that depends on credit and leverage becomes dangerous. Here's what you need to understand about Monday morning that most people will miss. The precious metals crash. Friday wasn't institutions panicking and selling because they think the thesis is broken. It was institutions taking profits on a parabolic move so they have dry powder for what comes next. They'll be back buying physical metal at lower prices because the underlying fundamentals haven't changed. China is still selling bonds. The deficit is still growing. The Fed is still trapped. The dollar is still falling. None of that got fixed by silver dropping from 121 to 99. What did change is now the speculative froth is gone. The leverage is reduced. The margin calls have been met. The exchanges raised requirements and flushed out the weak hands. That's actually healthy for the next phase, because it means the move higher when it comes won't be built on borrowed money and speculation. It'll be built on physical buying by people who understand the bond market just broke and paper assets aren't offering protection anymore. Your move this weekend, before Monday's open, is to understand what you're actually holding in your portfolio. Are you long paper promises from a government that just lost its biggest foreign creditor? Are you holding bonds that are falling in price as yields rise? Are you sitting in cash denominated in a currency that just hit 4-year lows with an administration that is not concerned about the decline? Or have you positioned in assets that maintain value when confidence in paper currencies erodes? This isn't about predicting the exact day the system breaks or timing the perfect entry. It's about recognizing that the breaking is already happening in slow motion. China's 9 months of selling, the Fed's loss of yield curve control, mortgage rates divorcing from Fed policy, silver hitting 121, then crashing to 99 in 6 hours. These aren't random events. They're all symptoms of the same structural failure unfolding across the bond market. China isn't betting against America. They're betting against paper. They're betting on 6,000 years of monetary history. They converted $170 billion from treasuries into physical gold because they did the math. The bond market needs buyers, the biggest buyer left. The Fed can't force yields lower. Your mortgage rate just proved it. Friday's crash was the warning shot. Monday morning is the deadline. Silver dropping from 121 to 99 wasn't the crisis ending. It was smart money exiting before the real break. The $682 billion hole China left does not get filled by hope or Fed press conferences. It gets filled by yields climbing until someone blinks. Do you really want to hold paper promises when the marginal buyer walked away 9 months ago? The storm isn't coming. It arrived Thursday night when metals hit records. It's overhead right now while you're watching this over the weekend. Monday morning, you'll see if you positioned or if you waited too long. The bond market is breaking. Not tomorrow, not next month. Right now, in real time. Your mortgage rate divorced the Fed. That's not supposed to happen, but it did. Because the bond market makes its own rules now, and China just taught everyone else how to play the new game. Build your position, load it with hard assets. But knowing what to buy is only half the battle. You need to know what comes after Monday's open. There's one specific indicator that tells you exactly when the Federal Reserve will be forced to abandon Kevin Warsh, his hawkish stance and print money again. It predicted 2008, it predicted COVID, and it just flashed red this Friday morning during the metals crash. If you want to see the chart that terrifies Treasury officials, click the video in the description. I'll show you the red line they're watching right now. I'll see you there.